All right, good afternoon, everyone. Welcome to week number 6 for PPA 555 public budgeting. Hope everyone's week is off to a good start. I'll apologize in advance. I know my voice is even stranger sounding than it usually is. I've been battling a cold for the past few days, and so hopefully my voice will hold out through the duration of class tonight. But just so you know, that's why I kind of sound a little more muffled than usual. So let me make sure that we are recording. We are recording. So before we get into our discussion tonight, and tonight our focus is going to be on tax revenue, and we'll go through the evaluative criteria of taxation, and we'll talk about those 5 evaluative criteria. And then we'll go through a discussion of the 3 major types of tax revenue: property, income, and consumption-based taxes or sales-based taxes. And then talk a bit about non-tax revenue, such as user charges, user fees, and monopoly-based revenue sources. But before we get into the information for tonight, let's just do a few housekeeping items and kind of reset where we are, because we are proceeding very quickly to the end of this class. It's a hybrid course. We go through the semester very quickly. It is accelerated. So this is week 6. So we'll do taxes tonight. Then next week, we'll have a regular session where we will do intergovernmental fiscal relations, and we'll talk about different types of grants and their advantages, their disadvantages, and then talk about some of the fiscal impacts of mandates that are handed down to local governments from state governments and handed down to state governments from the federal government. And then we'll kind of put a bow on everything and wrap everything up next week. So at the end of the session next week, we'll have covered all of our substantive information. And so then 2 weeks from tonight, it'll just be your final that you'll be working on. And so I think in 2 weeks, what we'll do is we won't have a regular session, but I'll be available during our course time to answer any questions you may have on the final exam as you are putting the finishing touches on that. So as of next week, we'll be done with all of our substantive information. And as of tonight, we should be done with all the information that you need in order to do the final assessment. But let's look back to last week and the Beach Board assignment that you did last week, looking at fiscal health, fiscal solvency indicators. I've gone through and reviewed all those, and I think everyone did a really nice job of using at least 2 or 3 of those indicators to assess fiscal health and fiscal solvency. Again, if we were going to do this in the real world of public budgeting, we would calculate these ratios, and we would do it not just for our city, but we calculate those the Brown's 10-point indicators for comparable cities as well. So you might put together a set of 10 comparable cities, calculate our ratios for our city plus all those other comparable cities, and then we compare those scores to each other. And so what we'd essentially do is we would array all the cities and then look at, is our city in the top quartile? Is it in the middle 50%? Is it in the bottom quartile? In order to see how well our city is fiscally positioned compared to other similar cities. Of course, we're not doing that here in this class, but if you're actually doing it in the real world of public budgeting, that's kind of how you would handle those Brown fiscal indicators. But for our purposes on Beach Board 3, I think everyone did a really nice job of, like I said, looking at least 2 or 3 of those fiscal solvency indicators. So thank you for those posts. Coming up next week, you then have Beach Board number 4. And for number 4, we kind of took it easy on that one because I know you're doing Beach Board 4 as well as putting the finishing touches on your post-instructional assignment. So for Beach Board 4, all you're doing is just briefly discussing the advantages and disadvantages of the different types of bonds that we talked about in class last week. And last week, we talked about long-term bonds like general obligation bonds, revenue bonds, double barrel bonds. So just discuss those types of bonds and what advantages and disadvantages those bonds have. And then that will suffice then for your Beach Board essay number 4. But then also next week, you have your post-instructional assignment that is coming due. So just as a reminder, I'm sure you've been working on this along the way, but just as a reminder, there are 2 parts to the post-instructional assignment. Part 1 is a redo of the pre-instructional, where you will re-answer those 8 questions that you answered on the pre-instructional assignment, but this time using all the information that you've acquired as being part of the class. So what I just think would be easiest for you to do is resubmit your pre-instructional assignment and then just add in the changes in your answers for the post-instructional, just put those changed answers in red, and then we can really see the differences between how you answered those questions in the pre-instructional versus how you're answering those questions here in the post-instructional. So part one is just that redo of the pre-instructional. Then in part two, you're putting together your consolidated line item budget for the library system. Again, you'll work off of that line item spreadsheet, that Excel spreadsheet that I provided for you, and you'll consolidate the library budget adhering to those parameters that were laid out for you in Form 56 in the Huddleston file. So you'll have to cut 3% of the overall spending. You'll have to standardize positions within salaries within classifications. You can't lay off any full-time employees. You can't close any branch libraries. So you have to adhere to all those parameters then in Form 56. So all you're submitting then for the post-instructional, part one, the redo of the pre-instructional using all the information you currently have, and then part two, an Excel spreadsheet and your justifications for whatever cuts you are making to the budget to reduce the budget by 3%. And again, you can make those justifications right in the Excel spreadsheet using the comment function if you are comfortable doing that. If you're not that comfortable with Excel, then you can provide the justifications in a separate Word document. But again, just tell me what cuts you made and why those cuts are realistic, and just give me some support for those cuts that you are proposing. So that's the post-instructional assignment then that is due for next week. I believe it's due on the 3rd, next Monday. So we've got that and the beach board essay that's due for next week. As you're working on the post-instructional assignment, if you run into any problems or have any questions, as always, feel free to reach out to me, and I'm happy to answer any questions you may have. So just drop me an email. But again, I think it's pretty straightforward, and it's just a matter of when you put your new budget together, just kind of playing around with some of the numbers and seeing how you can make the numbers work so that you can bring your budget in at 3% less than what you were spending before you consolidated the budget. When you put that line item spreadsheet together, since you are consolidating, you can go ahead and consolidate it down to 4 columns. So your first column would be the object of expenditure. Your second column would be the unit price for each one of those objects of expenditure. The third column would be the number of items within that object. And then the fourth column would be the product of multiplying column 2 times column 3. And you can make it as simple as that and just put together that 4-column spreadsheet. And that would truly be a consolidated type of library budget. Some people like to do that on one tab and then maintain the existing spreadsheet on a second tab, just so you can see each of the individual library branches. However you want to do it is fine, just as long as you are adhering to those parameters that were laid out in Form 56. Okay. Any questions, excuse me, on the post-instructional? Okay, anything emerges between now and next week, feel free to send me an email. Okay, very good. Then one more housekeeping item that I would like to discuss with you is we are speeding very quickly to the end of the class and coming up very quickly on the final assessment. So I have modified and made the final assessment available in our beach board class as of today. So I thought we'd spend a few minutes going through the final assessment. I'll walk you through the different scenarios, and we can talk about what types of things I'm looking for in terms of your answers on those scenarios. So let me go ahead and share out the final. And again, this is a final that you'll be working on between now and 2 weeks when it is due at the end of the class. You can use all the information at your disposal to complete the final exam. So it's nothing you have to memorize. You'll have all the information at your fingertips, and you can work on the final exam at your leisure. But the final exam or assessment, whatever term you like to use, I have final exam on here, but it kind of feels a lot more like an assessment because it has 5 different scenarios and then 2 questions related to each scenario. And obviously, I like to use these assessments because I think our focus in this class, as well as our focus in the entire MPA program, is all about finding that nexus between theory and practice. And so finding that ability to apply our theories in somewhat pragmatic types of situations. So there are not right or wrong answers on the final assessment. It's a matter of you justifying the answers that you're providing and why this approach or this theory would make most sense in this type of scenario. I don't think we've looked at this yet. If we have, please stop me and let me know. But let me just run through this quickly with you, what the different scenarios look like. Scenario number one. In scenario number one, this is your privatization type of scenario. We spent some time in the class talking about our justification for why we have public budgets and the justification for studying public budgets differently than how we would study a private sector budget. And we said one of the reasons why we have public budgets is because we categorize some goods as being public in nature and therefore worthy of public expenditure, worthy of having public taxpayer dollars spent on those types of programs and those types of goods and services. So in this scenario, you have this city, Lake Powell is located in the northeast region of the County of Confusion. Lake Powell has a population of approximately 75,000 residents and a healthy real and commercial property tax base. So it's got a good, healthy property tax base. The city is fiscally solvent and recently contracted with the county sheriff for law enforcement and fire services. So in California, as you probably all know, this is what we refer to as a contract city. So they don't have their own sheriff, they don't have their own fire department. They contract with the county to provide those types of services. It has been so pleased with the quality of the services it received through contracting that the city council is now considering contracting out its library services as well. The city currently has 2 library branches with a combined budget of $5.2 million. These branches are staffed with city employees. The city council received a recommendation from the city manager to consider entering into a contract with Library Alternatives Incorporated to staff and operate these branches. Library Alternatives Incorporated currently has contracts with 2 other cities in the state that allow the company to operate all aspects of library operations in these cities. So Library Alternatives Incorporated is a private company. It currently is running all library operations for 2 other cities. The city manager has seen this going on and wants to try and bring this arrangement into the city of Lake Powell. The contract that the city council will consider would replace the current city library employees with Library Alternatives Incorporated employees, and the company would commit to interviewing city employees first if they're interested in applying. So we'll be getting rid of all the city employees in the library in those 2 branches and replacing them with Library Alternatives Incorporated employees. But those displaced city employees have the first crack at applying for jobs to work with Library Alternatives Incorporated. So we're going to try and hold those employees harmless so that they can maintain their employment just with a private sector company instead of being employed by the city. The annual amount of the contract would be $4.5 million, resulting in $700,000 in savings for the city. And currently, the budget is $5.2 million. Library Alternatives can deliver library services for $4.5 million, so saving $700,000. One reason why the contract amount is lower than the current library expenditures is due to Library Alternatives' practice of charging membership fees for users. So they actually charge people a membership fee, an annual membership fee, to use their library services. There is a fee waiver, though, that they provide for users who can demonstrate that the fee would create a financial burden. So for any resident who can say this will create a financial burden to pay this membership fee, those fees will then be waived for those individual citizens. So it's a privatization type of situation. What kind of good would you consider library services and why? And we spent some time early on in the class talking about 4 different types of goods: public goods, private goods, toll goods, and common pool goods. And so we said public goods, they are non-excludable and they're non-exhaustible in that you can't exclude people who don't pay the fee from partaking in the benefits of those goods. And you also can't exhaust them. That one person using those goods will not exhaust it for someone else. So people are not necessarily rivals for those goods for a pure public good. Pure private good is the complete opposite. And with a pure private good, those goods are exhaustible and they are excludable. Then we say in the gray area between public and private goods, you have toll goods and common pool goods. Toll goods are excludable, but they are non-exhaustible. Common pool goods are non-excludable, but they are exhaustible. So which of those four types of goods do you think library services constitutes? And then give me a justification for why you think it's one of those four types of goods. And then if you were advising city council, what issues would you recommend that city council members consider in deciding whether or not to award the contract? So what are a couple of the salient issues that city council would need to think about before deciding to move forward with this contract and privatization of library services? As you answer these questions, remember to be parsimonious. And so we're looking for concise, parsimonious answers. You can usually handle each one of these questions in 1 to 2 paragraphs, and that usually is going to be sufficient for you to communicate your points. So 1, 2 paragraphs for each one of the questions certainly would work well. Then in scenario 2, we're going to continue with the city of Lake Powell. While the city of Lake Powell is thriving financially, the county of Confusion has not been so fortunate. Confusion is facing a myriad of fiscal troubles. To start, the county has failed to get its budget done on time for 6 of the last 7 years. One reason for this is the partisan divide within the city commission. While the commissioners are supposed to be nonpartisan, so local offices in the county of Confusion are supposed to be nonpartisan types of positions, it is clear that 2 of the commissioners are Democrats, 2 are Republicans, and 1 is a declined estate who normally caucuses with Democrats on some issues and Republicans on others. So you kind of have a split here in your 2 Democrats, 2 Republicans, and 1 who's in the middle on this commission. The second major problem the county faces is declining revenues and increasing expenditures. More affluent residents have been moving out of the county in recent years, thus eroding the real property tax base and making it more difficult for the county to balance its budget. Citizen watchdog groups have also filed a series of expensive lawsuits against county agencies claiming fraud and abuse in the way in which county programs are being implemented. So frustrated by the confluence of these events, the commissioners finally agree on one thing. It was time for a change in budgeting. They charge the city administrator's office, the CAO, with exploring different types of budget formats and presenting a recommendation to the county for how to change its current line item budget. You are a management analyst within the CAO and you have been tasked with recommending a new budget format. Given the limited information you have in this scenario, A, recommend a new budget format to replace the current line item approach and explain why this approach is most appropriate. Again, we're not looking for best, we're looking for most appropriate to fit this situation. And then 2B, select one of the formats you did not recommend and discuss why your preferred choice, the one that you're advocating for in question A, is superior to this format. Again, you can choose a performance-based budget, a program-based budget, zero-based budget, any of those types of budget formats that we discussed in class. Recommend one in 2A and then compare it to one that you're not recommending in 2B. So that's your budget format scenario. And we're trying to cover all the major topics we've covered in the course with these scenarios on the final assessment. And we do as well as we can to be as comprehensive as we can be. Scenario number 3, you finally complete your recommendation to the commissioners for a new budget format and are about to settle back into your daily routine. As you check your email, you realize there's a message marked urgent from Commissioner Rudy Diaz. It is somewhat unusual to receive emails directly from commissioners, so you immediately open it and find that Commissioner Diaz has a new task for you. Commissioner Diaz used to be Chief of Staff for Congressman Mayhew prior to running for the commission. You used to bump into him on Capitol Hill back in the day when you were interning for the House Ways and Means Committee, so Commissioner Diaz knows you are familiar with the federal budget process. He is anxious to change the county's budget process and thinks the county can learn a thing or two from the federal government. Why, I don't know, but he does. In his email, he asked you to prepare a memo to the commission describing the federal budget process and suggesting how adopting certain elements of the federal process could help the county. The CAO is aware of the commissioner's request and has cleared you to work on this memo. So 3A, describe the steps in the federal budget process that you would include in your memo to Commissioner Diaz. And remember, we talked about the 4 stages of the federal budget process, the preparation, formulation, implementation, and then evaluation. So discuss those 4 steps in the federal budget process and some of the things that happen within those 4 steps. And then in 3B, identify two aspects of the federal budget process that could be helpful for the county's process, and two aspects that would be hurtful and should be avoided. So two good things from the federal budget process that would be beneficial for the county, and two things that would not be beneficial for the county. So two good things and two bad things from the federal budget process. So I think that scenario gets us pretty far into the federal budget process and that part of the course material. Scenario 4, the fiscal problems of the county have extended to its ability to maintain county parks. The city of Lake Powell takes great pride in city parks, but there is one county park within city limits that has fallen into disrepair. Buzz Lucan County Park is located within the city of Lake Powell and is managed and operated by the county. It has been poorly maintained over the years, and the recreation center at the far end of the park is crumbling and not safe for use by residents. City officials have been complaining to the county commission for years that the park is an eyesore and should be renovated. The commissioners finally relent and agree to landscape and refurbish all aspects of the park with the exception of the recreation center. The recreation center is in such disrepair that will need a major renovation. The county simply does not have the resources or debt capacity to fund the construction project, so the city volunteers to step in and pay for the construction. It would require that the county allow the city to annex the land that the recreation center occupies, and the city would then own the recreation center. So the county is basically giving up the recreation center to the city, so the city can then renovate the recreation center. Demolition and construction costs are estimated to be $12.5 million. The county charges a fee for users of $10 per month, and the center had 5,000 users per month at its heyday. The city assumes it will be able to increase the number of users to $7,000 per month for a newly reconstructed center. So, people are going to be more willing to use this newly reconstructed center. So we will go up to 7,000 as opposed to only 5,000 users per month. So it kind of gives you an idea of the type of revenue flow that you're going to have in this recreation center. The commissioners agree to Lake Powell's proposal and the project gets the green light. Even though the city is fiscally solvent, it does not have the reserves necessary to fund the project. Therefore, it decides to issue a bond to fund this project. Based on the information in the scenario, what type of bond would you recommend and why? A general obligation, a revenue, a double barrel bond, and why you would recommend that type of bond. And then question B, compare the bond that you are recommending to another alternative and describe why your chosen bond is superior to that other alternative. So if you choose general obligation, why is that better than revenue? Or why is that better than a double barrel? So I get you your debt management type of information. And finally, scenario number 5. Between the privatization of the library system and the construction that's happening at the recreation center, things have been busy in Lake Powell. That is when news hits the local media. The city's largest employer, Wally's Widgets, announced it's moving operations to Morrisville by the end of the month. This will mean a 10% loss in corporate property taxes, which accounts to $5 billion in lost revenue, and an estimated overall loss of tax revenue in the amount of $7 million. Now the city needs to find a way to replace that revenue. They could replace the lost property tax in a number of ways. The county offers senior homeowners a $7,000 per year homestead exemption that reduces their property tax liability. The city offers an additional $2,000 exemption on top of the county exemption and could eliminate the additional exemption to generate additional property tax revenue. The fewer exemptions you have, the more valuation of property there is to tax, and the more revenue you can then generate from taxing that property. There are 1,500 parcels that currently receive this additional exemption, and its elimination would generate $3 million. So if you eliminate that additional exemption, that'll bring in an additional $3 million in revenue. Another option available to the city is to take advantage of the 20-cent local option sales tax that the county allows cities to use. Lake Powell has not needed to use this in the past, but taking advantage of this would generate an additional $4 million. The city does not have access to an income tax, but can increase the fee it charges to developers. There are 2 new developments in the city, and the city could generate an additional $3.5 million by increasing these fees. However, developers will certainly pass these fees along to new homeowners through increased home prices, which may discourage people from buying these new homes. So in question A, compare the major forms of taxation, property, sales, and income that we will all talk about tonight in terms of the evaluative criteria for taxation. So once we're done tonight, you'll have all the information you need to answer question 5A. And then 5B, what form of taxation or other source of revenue would you recommend to the city, and why would you recommend that source of revenue? So 5 is our taxation scenario. And as I said, after tonight's class, you will have all the information that you'll need in order to answer scenario number 5. So, questions? Any initial questions on the final assessment? Okay. Again, you have 2 weeks to work on this, and so as you are working on it, feel free to send me emails with questions you may have. I can't say, this is the most appropriate answer, but I can certainly guide you through your decision-making process as you answer these questions. You can use all the information available to you from the class to answer the questions, and again, there are no right or wrong answers. It'll just be a matter of justifying your answers, and how well you justify your answer will then be the determinant of the grade that you receive. Okay, I just thought it was good for us to go through the final assessment, so we're kind of all on the same page on it, and you don't just open it up and start working on it without any kind of context for why I'm asking the questions and why I'm presenting the scenarios that I'm presenting. I try to write scenarios that will give you the amount of information you need to accurately answer the questions without inundating you with details. And so I don't put a whole lot of details in there, but I want to give you enough information you need to go on to answer the questions. And I also like to kind of have a thread that ties all the scenarios together. So we're kind of dealing with the same city and the same county for all 5 of those scenarios that I've written. Okay, well, so you can answer number 5 on the final assessment, let's go ahead without further ado and get into our discussion of taxation and tax revenue. And the way in which we're going to do this is first we'll present what we call the evaluative criteria for taxation. This is something that John Mikesell talks about in his textbook. We'll talk about the evaluative criteria for taxation. Then we'll go through and talk about the different types of taxes, property taxes, income taxes, and consumption-based taxes. And when we are finished talking about each one of those forms of taxation, we will then link each form of taxation back to these tax evaluative criteria. And we'll see how each of those 3 forms of taxation will fare in terms of these evaluative criteria. Then once we're done with that, then we'll move into some non-tax revenue sources like user fees and user charges to kind of round out our revenue type of discussion tonight. So the way in which I like to deal with the evaluative criteria of taxation is when we are deciding as a government what form of taxation to rely upon, or whether or not we should increase a tax rate and how much we should increase that tax rate, we have to keep in mind these evaluative criteria. These criteria we can use for making those types of decisions. The first evaluative criteria for taxation is burden distribution. Burden distribution is simply who pays the tax. So we have to make a decision about who will be responsible for paying the tax, who will be shouldering the burden of taxation. And there are 2 different bases that we can use for that. We can use an ability to pay basis or a benefits received basis. Ability to pay is that we will charge a higher tax rate to people who have more fiscal wherewithal to pay the tax, who have a higher ability to pay the tax. So this is what you would think about when you think about something like the graduated income tax. So at least in theory, not in practice, but at least in theory, those who are at upper income levels will have more disposable income and therefore more ability to pay higher tax rates than people at lower income levels. So we base the burden to pay on an individual's ability to pay the tax. The second way we can look at burden distribution is on a benefits received principle. And that's what we do with consumption-based taxes like the sales tax, especially the general sales tax. You pay based upon the benefit you're getting from consuming this good or this service. So you go out there and you buy a commodity, you ostensibly consume that commodity, you will then derive a benefit from that consumption. So we tax you based upon the benefits that you are deriving from consuming that good or service. With a benefits received principle, what that means is if you do not receive a benefit, if you don't consume a good or service and receive a benefit from that consumption, then you don't have a tax liability. And that's what we see with, again, consumption-based taxes. So we have to decide who pays the tax, those with the ability to pay or those who derive a benefit from consuming a good or a service or a commodity. As we're looking at benefits, burden distribution, as we're looking at ability to pay versus benefits received, we always have to be very concerned about your second evaluative criteria, which is equity or fairness. How equitable, how fair is this form of taxation? Some forms of taxation are naturally fair. Some forms of taxation are naturally unfair. A fair tax is a tax that will be truly based upon ability to pay. So people with more of an ability to pay the tax pay a higher amount of taxation than people with less of an ability to pay. That's what's referred to as a progressive tax structure. We designed the graduated income tax to be a progressive tax structure. So we have marginal tax brackets that are indexed to the amount of adjusted gross income that you have. Higher your AGI, the higher the marginal tax bracket you will pay, the more progressive that form of taxation is. Now, obviously, there are a lot of loopholes and there are a lot of ways in the federal income tax code that people who have a great deal of ability to pay end up paying very little in taxes. And we'll get to that when we talk about the income tax. But at least in theory, a graduated income tax system is supposed to be designed to be a progressive form of taxation. The opposite of progressivity is regressivity. A regressive form of taxation is one in which people with less ability pay more in taxes than people with more of an ability. So a classic example of a regressive type of tax is a general sales tax. If you have a general sales tax that applies to all commodities, even the staples of life, that type of general sales tax will be regressive in nature because people with less of an income have less disposable income. And by disposable income, we mean income that's left over after they purchase the staples of life. So after they purchase food and shelter and clothing and prescription medication, after they purchase those staples of life, how much money do they have left over? That's their disposable income. And so if we have people with very low amounts of disposable income paying higher tax rates than people with, or equal tax rates with people who have a lot of disposable income, then the burden is unfairly placed upon lower income individuals. That then becomes a very regressive type of tax. So unless you exempt those staples of life from the general sales tax rate, that general sales tax is going to end up being very regressive in nature. So some taxes are naturally progressive, some are naturally regressive. Fortunately, there are a lot of different ways that we can manipulate taxes in order to make them more progressive in nature. And we'll talk about that as we go through property, income, and sales taxes in a couple of minutes. But we have to think about equity and fairness. Third, we have to think about adequacy. How adequate is this form of taxation? Does this form of taxation generate what we call an adequate yield? So the yield is the amount of revenue we are getting from that form of taxation. So does it generate adequate yield? Most of our forms of taxation that we use generate adequate yields. We wouldn't use them as governments unless they did generate an adequate yield. You look at something like the federal income tax. The federal income tax generates so much yield that the federal government relies almost exclusively on the federal income tax. There is no federal sales tax or any type of federal property tax. It's all federal income tax because the yield is so robust with the federal income tax. Obviously, you're going to have to generate an adequate amount of revenue to cover your expenditures, and that's adequacy. Then our fourth evaluative criteria is collectability. Some types of taxes are more collectible naturally than other types of taxes. And how you determine how collectible a tax is really has to do with the idea of, is that taxpayer active or is that taxpayer passive? Put those in text, Jeff. So is the taxpayer active or taxpayer passive? A taxpayer active type of tax is a tax in which the taxpayer takes a very active role in calculating and remitting the tax liability to government. In a taxpayer passive tax, the taxpayer doesn't have much role at all, and the tax is just remitted automatically. So an example of a taxpayer passive type of tax is a sales tax. So you go in to buy a commodity, there's a sales tax that will be applied to that commodity that you are purchasing that will increase the price of that commodity. You pay for that sales tax as part of the price of what you are purchasing. The vendor that is selling that good to you will then collect that tax and will then remit that tax to the state treasurer or the State Department of Finance, or however the state does it, will remit it to the state government. So the taxpayer doesn't collect and remit the tax. The vendor collects and remits the tax. That's a very taxpayer passive type of tax. Those types of taxes have very high collection rates because you're not collecting taxes from all these millions of individuals. You're collecting taxes rather from a much smaller subset of companies and vendors. So it makes it a very collectible type of tax. Think about the income tax. The income tax is an example of a tax that is both taxpayer active as well as taxpayer passive. It becomes very taxpayer active on April 15th when your federal income taxes are due and your state income taxes are due. You sit down, you fill out your tax form, you calculate how much tax you owe, and then you remit that tax to the government. So it's a very taxpayer active type of process. However, we also have withholdings. And so you can set up your withholdings, and your employer will then automatically withhold income taxes from your check. And that is a taxpayer passive type of process. So through withholdings, the income tax tends to be very collectible. When it gets to April 15th, it becomes a little bit less collectible. And that's when we then have to have mechanisms of enforcement to make sure that the government is actually getting the yield that is owed to it from this form of taxation. So it's kind of a mixed bag with the income tax. It can also kind of be a mixed bag with property taxes as well. If you're a homeowner, you know that property taxes, you can either pay directly to the county with your twice a year property tax bills that you get, or you can have property taxes impounded into escrow where they are kind of rolled into your monthly mortgage payments. Obviously, you're having them impounded into escrow. Typically, if you have less than 20% down on a house, you'll have to have them impounded into escrow. That's very taxpayer passive because it just becomes part of your monthly mortgage payment. If, however, you don't have them impounded, then twice per year you get this very big property tax bill, and it's up to you to then remit that taxation then to the county. So it's both taxpayer passive as well as taxpayer active, depending upon how you choose or how you are forced to have those taxes collected. So collection really is based upon how taxpayer passive or taxpayer active the type of taxation is. If you can't collect the tax, then obviously you're not going to have an adequate yield. So adequacy and collection are inextricably linked to each other. For tax collection, we usually refer to that as being tax effort. So whenever credit rating agencies look at governments, they will look at their tax effort, how successful they are at collecting the tax that is owed to them. For the property tax, you have to collect at least, at a minimum, 90% of the property tax levy that is owed to the government. If you're collecting less than 97% of the property taxes owed to the government, then you are certainly going to get a lower credit score, a lower bond rating, because you're not collecting what you're supposed to collect from the property tax. So tax effort is the ability to actually collect that tax. Adequacy is more of a measure of what we call tax capacity. So the capacity of the government to generate tax revenue. That's tax capacity. What they actually collect is based upon their tax effort. And then the final evaluative criteria is economic effects. And this is a two-way street. So when we're looking at a form of taxation, we have to ask the question, number one, how does the tax affect the economy? And then number two, how do economic fluctuations affect the tax? So in your undergraduate economics courses, I'm sure you looked at the Laffer curve. You're all very familiar with the Laffer curve. And when we look at the Laffer curve in terms of things like the sales tax, we realize that as we increase our sales tax rate, the amount of sales tax revenue we generate will increase as well up to a certain point. At a certain point in time, you get to this critical mass where the price becomes too high for people to purchase. And then demand becomes very elastic, as we had talked about last time when we talked about cost benefit analysis. Once demand becomes elastic, people will stop purchasing the good. And if you continue to increase your sales tax rate, your sales tax revenue will actually start to go down. And so you've kind of got this curve where it goes up for a while, then you hit too high of a sales tax rate, and then it starts to go down again. So we know that something like the sales tax will have an impact upon economic activity and the decisions made by consumers in the economy. So there's a limit in terms of just how much we can raise that sales tax. Now, if the good is very demand inelastic, then we're going to be able to continue to raise our sales tax and we'll continue to get revenue. Something like gasoline, motor fuels. We're all dealing with high gas prices now. But for the most part, gas is pretty much price inelastic in that people need to purchase gas. They need to get back and forth to work. They need to get home. They're going to purchase the gas, sometimes irrespective of how much the tax is on a gallon of gasoline. So that's a very price inelastic type of good. There are a lot of other goods that are very price elastic. Excuse me. So something that's price elastic is something, again, that consumption is going to be depressed the higher you raise the tax rate. So taxes can have an impact upon the economy, but the economy can have an impact upon taxes as well. We know that if we have high levels of unemployment, people are out of work, they're obviously not earning an income. If they're not earning an income, then you don't have income tax revenue coming into the government. If they're not earning an income, they're not going out there and buying goods in the market. And so therefore you have less sales tax revenue as well. If they're out of work and interest rates are very high, they're not going to be purchasing homes. If they're not purchasing homes, then you're going to have a reduction in your property tax rate as the housing market crashes. So the economy can have an impact upon the tax, and the tax can have an impact upon the economy. So with economic effect, we're asking the question, how well insulated is this form of taxation from the economy? Some forms of taxation are better insulated than others, and we'll see that as we go through our discussion of the three main forms of taxation. So as we talk about the three forms of taxation, keep these evaluative criteria in mind because we're going to return to them at the end of our discussion of each form of taxation to see how that form of taxation relates to those five evaluative criteria. So let's start with our first form of taxation, the property tax. We know that the property tax is primarily the domain for local governments, and local governments get a good bit of their revenue from the property tax. The property tax is no longer the primary source of revenue for local governments here in California. And the reason for that is Proposition 13. And we'll talk at length about Proposition 13 in a couple of slides, but Proposition 13, when it was passed by the voters in 1978, placed a limitation on the total amount of property tax revenue that local governments could generate. So it led to a loss of a great deal of property tax revenue for local governments. Now that loss wasn't immediate in that it was passed by voters in 1978. For the first 2 or 3 years after the passage of Prop 13, the state government backfilled and gave state money to local governments to kind of hold them harmless from this loss in property tax revenue. As of about 1981, they kind of backed off from that backfilling, and that's when local governments really started to feel the full impact of the limitation on their ability to generate property tax revenue. So because of that, a lot of local governments in California rely more on user fees and user charges, non-tax sources of revenue, than they used to. And so those user fees and user charges have kind of supplanted property taxes as the primary source of revenue for most California local governments. The property tax tends to be naturally regressive in nature. And it tends to be naturally regressive in nature because when you pay your property tax, you're paying your property tax out of your income. Most people are not going to refinance their homes or sell their homes to pay their property tax. So you're going to pay it out of your liquid income. There can certainly be a big disconnect between your income and the value of your home. If you've got that disconnect between income and the value of your home, the property tax is based upon the value of the home. And so if you have a home that is a $900,000 home and you have an annual income of $30,000, you're going to have a very regressive form of taxation. So it's kind of that disconnect between how people pay and how they're charged that makes the property tax relatively regressive in nature. The way the property tax works is the amount of property tax revenue that a local government will generate is dependent upon the rate that is charged and assessment rates. So basically, the amount of property tax revenue that you're going to get from a parcel of property is based upon the property tax rate as well as the assessed value of that parcel of property. The assessed value of that parcel of property is the value of the property that is subject to property taxation. So if you only have a tax rate limit, but you don't have any limitation on how much you can assess the value of property at, then that doesn't limit the amount of property tax revenue that local governments can generate. They may be limited in terms of the tax rate they can charge, but they can just infinitely increase the assessed value of property and generate more and more property tax revenue. Likewise, if you have a limitation on assessed value, but you don't have a limitation on the property tax rate you can charge, you can just raise the property tax rate and get more property tax revenue in that manner. When we have a restriction on the amount of property tax revenue a local government can generate, we have what's referred to as a property tax levy limit. And that is a combination of a rate limitation and an assessment limitation. That's what we have here in California with Proposition 13. Proposition 13 imposes a 1% tax rate limit, meaning that the amount of taxation that can be applied to a parcel of property cannot exceed 1%, although it does. And if you look at your property tax bill, you may see that your property tax bill is 1.2% or 1.3%. Or if you live in a community facilities district with Melrose taxes, it could be as high as 2.5 or 3%. But the statutory limit is 1%. To go above that 1%, you're talking about local add-on types of property taxes. So if you live in an assessment district to pay for those streetlights, you may have a rate above 1%. If you live in a community facilities district, a new house in a new development, there could be some Melrose tax that's applied above and beyond the 1% property tax rate limit. But technically, the property tax rate limit in Prop 13 is a 1% limitation, which is $1 per $100 of assessed valuation. It's a percentage. So 1% is 1 per 100. That's how we talk about rate limits here in California. We talk about them as percentages. Not every state uses percentages for their tax rates. In a lot of states, they will use what's called millage rates. A millage rate is $1 of taxation per $1,000 of assessed valuation. So a percentage is 1 per 100. A millage rate is 1 per 1,000. So you can, very easily go back and forth between the two. So a 1% tax rate is equivalent to a 0.1 millage rate. A 10% tax rate is equivalent to a 1 mill rate in another state. But here in California, we use percentages. So we're just going to kind of stick with percentages for our discussion here tonight. So we have that type of rate limit, but we also have a limitation on the increase in the assessed value of property built into Prop 13 as well. The assessed value of property can only increase by a maximum of 2% per year unless that property changes hands or there are some major improvements to enhance the value of that property. But if you own a home and you don't do major improvements, like you don't put in a pool or a second story or anything like that you're pulling permits for, then the property value for taxation purposes can only increase by a maximum of 2% year after year after year. So when you combine that 1% tax rate limit and that 2% assessment rate limit together, that's what gives you this property tax levy limit like we have here with Proposition 13. So some of the important aspects of calculating a property tax are going to be the rate and the assessed value of the property. Governments need to come up with some mechanism for valuing property within their jurisdiction. And every government will have an assessed value of property within their jurisdiction. There are different ways to come up with that assessed value. Some governments in some states will reassess property every single year. So they'll have an annual reassessment cycle for the value of property. Other states will do it less frequently. Some states will do it every 3 years, every 5 years, every 7 years. But the typical approach is an annual reassessment of value of property within the jurisdiction. So how do you then do it? Well, one very common approach to assessing the value of property is the market value approach. In the market value approach, we ask the question, what should this house sell for if it was up for sale today? So what would this house sell for today in today's market values? And so what it would sell for if it was being sold today then becomes the market value for this home. So some states that use this approach, they will go out there and do a comparable sales type of approach where they'll look at all the houses that are comparably situated in a neighborhood that's sold in the past year. They'll get the value of those houses, and then they'll use that average for the market value for this home that they are valuing. That's a market value type of approach. There's current market value and true market value, but we won't get into those here tonight. We'll just deal with market value as what the house should sell for if it was up for sale. That's not what we do here in California. Here in California, under Proposition 13, we have an approach known in a pejorative way as the welcome stranger approach. It's called the welcome stranger approach because it's essentially welcome new person, welcome stranger. Here's a big tax bill for the house that you just bought. In a welcome stranger approach, the value of homes will be reassessed whenever those homes change hands. So whenever the house sells, then if whatever price it sells at will then become the new value, assessed value for that home. So you could have a home that maybe was purchased for $25,000 in 1950 and then sells for $900,000 in 2022. That person who purchased the home for $900,000 in 2022 will then have an assessed value of $900,000, as opposed to the person who owned the home all these years who had a $25,000 valuation that only increased by 2% per year because of Proposition 13. The problem with the welcome stranger approach is it violates equity. And there are two aspects of equity. When we talked about the evaluative criteria, we said equity is that second criteria. There are two ways to look at equity. There's vertical equity and there's horizontal equity. Vertical equity talks about fairness between taxpayers of different capabilities, so that people who have more income will pay more in their taxes than people who have less income. That's a vertical type of equity. But then there's also what we call horizontal equity. Horizontal equity postulates that citizens, taxpayers who are situated similar, they're in a similar situation, should pay similar tax burdens. So if you have someone who owns a home and next door is an identical home, so the homes are exactly the same, they have the same square footage, they were built in the same year, they have the same amenities, but the one house sold in 1970 and the person's been living in the house since 1970, but the house next door sold in 2022. That house next door that sold in 2022 because of the welcome stranger approach is going to have a much higher tax liability than the house that sold in 1970. And that's because of this welcome stranger approach that we get from Proposition 13. So that's how we assess the value of property here in the state of California. We'll talk again more about Prop 13 coming up really soon in a future slide, because it's that important for property taxes here in California. Another approach that can be used is what's called the income approach. And this is for some type of parcel of property that's generating an income flow. So if you have an apartment building and the apartment building is going to generate rents, you can use an income basis to value the apartment building. You can base the value of the apartment building on how much rent the apartment building is going to generate each and every year. The question Kettering asks, how do other states handle property tax if they don't have a similar Prop 13? A lot of states do have their own property tax levy limits that are somewhat similar to Prop 13, not quite as strict as Prop 13. But for states that don't have property tax levy limits, local governments have almost unfettered access to property taxes, in that if they only have a rate limit and they don't have an assessment limit, then they can generate more money out of the property tax by increasing assessed valuation or vice versa. And so without that property tax levy limit, you see a lot of those local governments in other states being very heavily reliant on the property tax. In some states, local governments are so reliant on the property tax, they're generating 80, 90, 95% of their revenue from the property tax because they don't have a similar type of levy limit like we have with Proposition 13. A lot of other states model their limitations on Proposition 13. The state of Massachusetts have what they call Prop 2.5. Yes, it's called Proposition 2.5. It's called Proposition 2.5 because the assessment limitation was 2.5%, and that's why they called it Prop 2.5. State of Ohio has what they call House Bill 920, which is a similar type of property tax levy limit. So a lot of states kind of modeled their approach after California in Prop 13. But some states don't have those, and those that don't have them, their local governments are very heavily reliant upon property tax revenue. Another basis for assessment is the costing approach, where you ask the question, if we had to replace this parcel of property, how much would it cost to replace this parcel of property? And you use that costing approach to then assign a value. In most states, they will have what they call fractional assessments, which means that they will assess different types of property with different fractional tax rates. So to give you an example, in some states, especially farming states, they will apply a different fractional assessment to agricultural property than they will to a private house. And so in a private house, they may have a 30% assessment rate in that they will charge an assessed value equal to 30% of the fair market value of that house. But for agriculture property, they may only charge a 10% assessment rate. So they're only charging 10% of the market value of that agricultural property. And again, the reason why you would have a lower fractional assessment for agriculture property is that it's in the course of doing business. And so obviously, you want to try and protect that business. You want to try and protect farmers. So they have a lower fractional type of assessment. Here in California, our fractional assessment rate is 100%. Our fractional rate is 100% of the assessed value of the property. So we're at 100%. But if you were in a state like, going to the Midwest, go to Ohio, and if you had a $300,000 assessed value of property, you would multiply that times 30%, and then that $90,000 would then become the amount that you're paying taxes on. And so you're not paying taxes on the full $300,000 value of your property. You're paying taxes only on the $90,000 of assessed valuation. That's how fractional assessment types of rates work. But here in California, we're 100%. So it's 100% of what that house sold for when that house changed hands. The hope is that you will charge similar rates to similarly situated taxpayers. That's horizontal equity. You don't do a very good job with horizontal equity here in California when you have the welcome stranger approach, because then that person who purchased their home in 1970 is going to have a fraction of the property tax bill that the person who purchased their house in 2022 will have. So we have great variation and great dispersion in terms of the property taxes paid by similarly situated homeowners. And it's a problem with the welcome stranger approach, but that's what we have here in California with Proposition 13. So let's talk a little bit more about Proposition 13 and what Proposition 13 is and how it reduces tax burdens for property owners. Here in California, there are three main categories of property tax reductions. There's Proposition 13, which we'll talk about extensively on the next slide. Then there are what are called exemptions. Here in California, there are exemptions known as a homestead exemption. A homestead exemption will exempt the first $7,000 of the value of your property from taxation. So your property is being assessed at 100% of its current market value, but then we'll immediately take $7,000 off that value and shield $7,000 from property taxes. We will exempt $7,000 of the value of your home from property taxes. There are also exemptions that apply for elderly citizens. There are exemptions that apply to citizens with certain types of disabilities. The state of Florida, I taught in Florida for a year, and the state of Florida is very well known for its exemptions for senior citizens. And not surprisingly, because of the demographics of their population, They really do cater to senior citizens, and senior citizens can exempt a large percentage of the value of their home from property taxes. So, exemptions allow you to shield a percentage of the value of your home from property taxes. Then there is another category of property tax reductions known as abatements. An abatement is a negotiated tax reduction. And so if you want to attract a corporation into your jurisdiction, you will offer them a tax abatement. And you may say that we will give you a 50% tax abatement for your first 5 years of operation. So if you come to our jurisdiction for the first 5 years you're operating here, you'll only have to pay 50% of your normal property tax bill. That's an abatement because it's negotiated between the government and the taxpayer, oftentimes what is a corporation. The one that is really important, obviously, here in California is Proposition 13. And so we really need to spend some time talking specifically about Proposition 13, why it was passed by the voters, and then how it has been changed over the years. So again, Proposition 13 was passed in 1978, and the primary purpose was to shield homeowners from being taxed out of their homes. So we had very quickly appreciating property values because a lot of people were moving into California. People moved into California, property becomes more in demand, and it then becomes more valuable. And people who are already living here were being taxed out of their homes because their assessed value was going up and up and up every year when it was being reassessed. So Proposition 13 put a limitation on the amount that the assessed value of your home could go up to a limitation of 2% per year. It could not increase more than 2% per year to, again, shield homeowners from being taxed out of their homes. Is a 1% tax rate limitation and a 2% assessment rate limitation, which then combines to make it a property tax levy limit that limits the overall amount of property tax revenue that local governments can generate. In 1986, we had an addition or a modification to Proposition 13 in the form of Proposition 58. And Prop 58 in 1986 built in an exemption for property that was being transferred from parents to child. So if a parent was going to sell their property to a child, that child could then retain the assessed value that that parent had for that property. So it wouldn't then revert to the true market value. You could hold on to that lower assessed valuation that the parent was paying whenever it's transferred to the child. Then in 1996, we had Proposition 193 that then allowed grandparents to transfer property to their children and their grandchildren, and their grandchildren then maintain the same assessed valuation that the grandparents had been paying. Now, there's a limitation there, obviously, that if it's a grandparent who is transferring this property to their grandchild, you're kind of skipping over the parents, and there must be a reason why it's the grandparent to the grandchild. If it was a grandparent to the parent, it'd be Prop 58. If it's a grandparent to the grandchild, it's Proposition 193. But 58 and 193 expanded the protections of Proposition 13 to inherited property for children. Then very recently in 2021, we ended up getting Proposition 19. And I know it's maddening here in California that we have so many propositions and we have numbers for all of our propositions. And annoyingly, we use the same numbers over and over again. So there are multiple Proposition 19s in the history of California. But this Proposition 19 in 2021 put a limitation on the ability to transfer the assessed value of property to an offspring, to a child or to a grandchild. As a Proposition 19, if a child or grandchild would benefit from this transferring in the assessed value from their parent or the grandparent, that house must be the primary residence for that child or for that grandchild. So that child or grandchild was getting this property to use as a rental piece of property, then Proposition 13 protections would not apply. It must be their primary residence, and it cannot be valued at more than $1 million. So it had to be valued less than $1 million in order to get those Proposition 13 protections. So in a way, in Prop 19, we limited the coverage of Proposition 13, but we also expanded it a bit with the second provision for Prop 19, where taxpayers who are 55 years or older or taxpayers who were disabled, or taxpayers who were subject to a natural disaster could transfer their Prop 13 assessed valuation from their old property to a new property. But the catch here is only if the value of the new property is less than the value of the old property. So it doesn't really have the type of benefit that a lot of people thought it might have, but you can hold on to the assessed valuation as you move to a new piece of property, and you can do that up to 3 times throughout your lifetime. So in a way, we expanded Prop 13 with Prop 19, but in a way, we also limited it as well. But again, Proposition 13 has been with us since 1978. One of the reasons why it was so successful at the ballot box is because it's the support of the Howard Jarvis Taxpayers Association. And the Howard Jarvis Taxpayers Association was the major proponent of Proposition 13, still remains a major proponent of keeping Proposition 13, even though there have been many attempts along the way to try and gut Proposition 13. The Jarvis Foundation always fights against trying to make any major changes to Proposition 13. There was what was called the Split Roll Initiative back in 2020 in a proposition called Prop 15. In Prop 15, the Split Roll Initiative, the initiative would divide out property owned by citizens, by individuals, from properties owned by businesses. Because under Proposition 13, those protections apply to both individual property as well as property owned by businesses. So the Split Roll Initiative would separate those out and would then make business property exempt from the protections of Proposition 13, which would bring in billions upon billions of dollars in property tax revenue to local and to state government. That Split Roll Initiative went down to defeat in 2020. There were some rumblings that it would be back on the ballot in 2022. It looks more likely that it will be back on the ballot in 2024. And again, the whole purpose of the Split Roll Initiative is to carve out businesses from these Proposition 13 protections. So the Proposition 13 protections only apply to property owned by individual taxpayers as opposed to property owned by businesses and corporations. But Proposition 13 it casts such a long shadow over property taxes here in California that you really can't understand property taxes as a revenue source in California without acknowledging the impact that Proposition 13 has had. Again, Proposition 13 has reoriented the focus in local governments away from relying upon the property tax and refocused their attention more on non-tax sources of revenue like user fees and user charges. And so it kind of forced local governments to engage in revenue portfolio diversity, to become much more diverse in the types of revenue that they are generating. So they're no longer a one-trick pony with property taxes. Now they really diversify into a lot of different sources of revenue. And I'll show you, after we go through all of our different forms of taxation, I'll show you a nice little pie chart that breaks down for the average city in California what types of revenue they rely upon, what percentage of revenue comes from which type of source. But how does the property tax fare in terms of those 5 evaluative criteria that we started our discussion with tonight? Well, in terms of burden distribution, the property tax is a wealth-based tax. The measure of your wealth is the value of your home. So since the measure of your wealth is the value of your home, it is an ability to pay type of taxation. We said it can be very regressive because if there's a disconnect between your annual income and the value of your home, it can become a big burden on you to try and pay your property taxes. It also, as we said, is very bad with the way we do it here in California for horizontal equity. In that Proposition 13, this welcome stranger approach of reassessing the value of property when it changes hands causes wildly divergent tax rates for taxpayers who have similar wealth and similar ability to pay those taxes. It is a very adequate form of taxation. It became less adequate after the passage of Proposition 13, obviously, but it still is a relatively adequate form of taxation. It's a very collectible form of taxation in that, as we said before, the expectation is that a government will collect at least 97% of the property tax levy that is owed to that government. So it's a very collectible type of tax. And in terms of economic effects, it is a pretty insulated type of tax from the economy. Now, it is true that if you have a housing crisis and you have a housing bust like we had in 2008 or whenever it was here in California, the amount of property tax revenue generated for that local government will obviously go down. But absent those big housing market crashes, which are relatively infrequent, for the most part, property values tend to go up and they tend to be at incline in terms of the trends for property tax revenue. And so it's usually pretty well insulated from economic fluctuations. Now, certainly when you have situations like the Federal Reserve that continues to increase interest rates, that will depress the housing market. Fewer people will be able to qualify for a house because it becomes more expensive. Demand for houses will go down. As demand goes down, prices of houses may go down. And so when houses sell, they may be selling for $750,000 instead of selling for $900,000 in the overheated market. Certainly, that's going to have a depressing impact upon the amount of property tax revenue generated. But when you compare it to the income tax and the sales tax, the property tax really is the most insulated form of taxation from economic fluctuations. However, even though it's insulated from economic fluctuations, the property tax is still the most hated form of taxation. And we always have these surveys asking taxpayers to compare the property and the income and the sales tax and to compare them based upon favorability. And what we usually find is the income tax is the most favored type of taxation. It's seen as being the most fair type of tax. And the property tax is the most hated form of taxation. And one of the reasons why it's the most hated form of taxation is if you don't have your taxes impounded into escrow, then twice per year you get this very large property tax bill. So it's a very visible type of tax. And there's something in the budgeting literature known as the fiscal illusion argument. And the fiscal illusion argument says that taxes that are very visible to taxpayers tend to be the most hated forms of taxation. Those that are less visible are less hated. So it makes sense. The property tax, you get a property tax bill twice per year. That's kind of a slap in the face that you're paying all these thousands of dollars twice per year. It's very visible. It's very painful. However, with the income tax, if you're having your withholdings worked out correctly, then when it comes time to file your taxes in April, you may break even or you may get a refund. And you don't really see the taxes coming out of your check each week as clearly as you see these two property tax bills that come in twice per year. So that fiscal illusion argument kind of tells us why the property tax tends to be the most hated form of taxation. But again, the local governments, even in the wake of Proposition 13, local governments still derive a healthy amount of the revenue from the property tax. And so the property tax tends to be the primary vehicle for revenue generation still today for local governments across the entire country. So that's our first time of taxation, the property tax. Before we get into income taxes and sales taxes, we've been going at it for a while now. So let's go ahead and take a break. Let's take about a 10-minute break. We'll just say come back at 5:25. We'll call it that. Come back at 5:25 and we'll talk about income taxes, sales taxes, and if time permits, non-taxable forms of revenue such as user fees and user charges. So come on back at 5:25 and we'll get into the income tax. Okay, welcome back. It's 5:25, so we are back from break, and we'll spend the rest of our time talking about income and consumption-based taxes, and we'll do the same thing we did with property taxes, that we will link them back up to those 5 evaluative criteria once we're done talking about the different features of both income as well as consumption-based taxes. So let's start with income taxes. We know income taxes are primarily the domain of the federal government and state governments. Here in California, it's not in the domain of local governments to use income taxes. However, in a lot of other states, local governments do have access to an income tax. In some states, city governments can levy an income tax. In some states, county governments can do it. And even in some states, school districts also have access to a local option income tax. But here in California, primarily the domain of the state government. And as we know, the federal government generates the vast majority of its revenue from the federal income tax. Now, again, the income tax tends to be a more progressive type of tax because we have instituted a graduated tax system, both at the federal level as well as here in California. And a graduated tax system means that we have different marginal tax brackets. So marginal tax brackets mean that you will pay a certain percentage up to a income threshold. And then for every dollar above that income threshold, you then pay at a higher percentage up until another income threshold. And then above that, every dollar above that income threshold, you then move to a higher tax bracket. That's what we mean by marginal tax brackets. And it's graduated because you move up in those tax brackets based upon the increase in the adjusted gross income. So the primary indicator of your ability to pay taxes will be your AGI, your adjusted gross income, as calculated on your tax forms for the federal and for state government in April. So the way in which the process works is at the federal level, and these are 1 year old, but the way in which the process works is you have several different tax brackets, marginal tax brackets. You can see is on the screen. The amount that you pay will depend upon your income as well as your filing status. So in this example, we have our marginal tax brackets of 10, 12, 22, 24, 32, 35, and 37%. Then we have our categories of filing: single, married filing jointly, head of household. There's also married filing separately is another category that's not on the screen. But you'll see as your income goes up, you move into higher marginal tax brackets. So say, for instance, you're a single taxpayer. So your first $9,875 will be taxed at the 10% tax rate. Then for every dollar above $9,875 up to $40,125, every extra dollar will then be taxed at 12%. Then every dollar above $40,125 up to $85,525 will then be taxed at 22%, and so on and so on. So if you make $520,000 as a single individual, you may say my tax bracket is 37%, but you're not paying all of those $520,000 at the 37% rate. You'll pay 37% for every dollar above $518,400. Married filing jointly, as you can see, you don't move through the tax brackets as quickly because the idea is if you are married filing jointly, it takes more to sustain that household than if you were a single individual, and so therefore the income thresholds tend to be much higher for that filing category. So that's how the federal income tax marginal brackets work. Same type of idea here in California. We also have a graduated marginal tax bracket system. You can see the different tax brackets run from 1%, 2, 4, 6, 8, 9.3, 10.3, 11.3, 12.3, and at the highest level, 13.3%. And they can see the income levels that then are attached to each one of those different tax brackets. So again, you're not paying your entire $1.2 million at the 13.3% rate. You're only paying the 13.3% rate for every dollar above $1,181,484. So the nice thing about having a graduated marginal tax bracket system is it at least gives us the illusion of progressivity and fairness. Now, we do know that there are a lot of what we call circuit breakers that are built into the income tax system that are meant to reduce the tax burden of individuals for a variety of different reasons. The federal income tax code is literally thousands upon thousands of pages in length, and there are a lot of different types of deductions and a lot of different types of tax credits that taxpayers can take advantage of to substantially lower their income tax burden. That's why you hear stories about corporations that are multi-billion-dollar corporations that pay very little in income taxes. People who are making millions upon millions of dollars are able to shield a lot of their income through using a lot of these circuit breakers to lower their effective tax rate to a level below what someone who's making $30,000 or $40,000 would have to pay. The effective tax rate, there are two things. There's the nominal or the what's called the legislative tax rate, and then there's the effective tax rate. So the nominal tax rate is the tax rate according to law. And so all those different tax brackets, those are the nominal tax rates. So technically, you could be in a 37% tax bracket for the federal income tax rate, but your effective rate is the actual tax rate that you pay after deductions and after tax credits. That effective rate is going to be much lower than the nominal rate. So if your nominal rate is 37%, once you get done with all of your deductions and all of your tax credits, that 37% nominal rate could actually be as low as maybe 5 or 6% as an effective rate, depending upon the types of deductions and credits that you have. So it's really those circuit breakers that sometimes call into question the fairness and the progressivity of the graduated income tax system. So let's talk about some of those circuit breakers and how those circuit breakers work, what they're intended to do versus what they oftentimes actually result in. So probably the most common type of circuit breaker is what's called a deduction. And deductions are there again to lower the nominal rate down to an effective rate, to make sure you're paying less than what your statutory nominal rate would lead you to believe. So we use deductions for a lot of different purposes. We use deductions to adjust for filing status, whether you're filing single, whether you're filing married separately, married filing jointly, head of household. We use deductions to try and adjust for those filing statuses. There are standard deductions and itemized deductions. Now, this was a major change in 2017 in the Trump administration with the Tax and the Jobs and Tax Cut Act. And I always get the name of it wrong, but the big piece of legislation in 2017 where the Trump administration, Republicans in Congress were able to greatly expand the value of the standard deduction. The standard deduction is something that everyone qualifies for, and you'll choose the standard deduction unless you have a lot of other deductions that you would like to itemize. So if you don't own a home and you don't have any mortgage interest deduction to claim, if you don't own a business and you don't have business deductions to claim, if you don't have a lot of medical expenses that you are claiming, if you don't have a lot of charitable donations that you are claiming, then you don't want to itemize, you'll just use the standard deduction. The standard deduction was greatly increased in 2017 to incentivize a lot of people to take the standard deduction rather than itemizing their deductions. If you get a lot of people to take the standard deduction as opposed to itemizing deductions, it streamlines the tax process and it makes it easier for them to fill out their taxes, makes it easier for the IRS to review those tax forms. And it was the whole goal was to try and make the process as easy as possible so that eventually people would be able to fill out their taxes on one sheet of paper. And that's all they would need to file their taxes in April. However, if you own a home or you have charitable deductions or charitable donations, or if you have a lot of medical bills or you own a business, chances are you will get a greater deduction if you itemize those deductions and you actually stipulate those deductions rather than just taking the general standard deduction. The single biggest deduction that we currently have in the tax system is the deduction for the interest paid on mortgages. So you can deduct all the interest that you are paying every year on your mortgage, deduct that from your adjusted gross income, which will greatly reduce your property tax liability. Likewise, if you make a lot of charitable donations, you can deduct each one of those charitable donations. If you have medical bills above a certain threshold, you'll be able to deduct those medical bills as well in itemized deductions. So essentially, if all your itemized deductions add up to a greater value than the standard deduction, then you'll want to itemize. If not, then you want to claim the standard deduction. The reason why we allow people to itemize certain deductions is having itemized deductions encourages certain types of behavior on the part of our taxpayers. So we want to try and encourage people to purchase houses. And so you encourage them to purchase property by allowing them to deduct the interest on the mortgage that they are paying. You want to encourage charitable donations. Also, another reason why we use itemized deductions is we want to protect people so that they are paying their taxes on net rather than gross income. So you want to protect people if they have a lot of medical expenses, so they can take out those medical expenses and pay less in taxes. If people are relocating for a job and they have to go through required job training, those costs we want to allow them to deduct so that we are taxing on their net rather than their gross income. And as Flutie says, yes, did it also get rid of a lot of state and local tax deductions and exemptions? It absolutely did. It capped what's called the state and local tax deduction, or the SALT. It capped that at $10,000. In the past, you could deduct all the taxes that you pay to state government and local government. You could itemize that and deduct that from your adjusted gross income. As a result of the 2017 legislation, they placed a cap of $10,000 on that. So you can only deduct up to $10,000 of taxes paid to state and local governments. That hurt a lot of people in high tax states. So people who live in California, New York, Massachusetts, those high tax states, taxpayers in those states used to deduct a lot more than $10,000 because they're paying a lot more than $10,000 in state and local taxes. Now they can only deduct up to $10,000. So you're right, it did place a very strict limitation on your ability to deduct state and local taxes paid. There are a lot of deductions. I mean, we certainly, it's well beyond the scope of this class to get into all the nuances of deductions in the income tax code, but there are a lot of deductions out there that people are very good at leveraging in order to lower their effective rate as low as possible. Also, in the 2017 law, as Felipe alludes to in text chat, they also eliminate these things called exemptions. In the past, before 2017, you could claim exemptions for every member of your household to adjust for family size. The idea was that if you had a household of 6 members as opposed to a household of 2 members, it takes more money to support a household of 6 as opposed to a household of 2. So you could claim an exemption for each member of that household and subtract those exemptions. There would be a value that's usually about $7,500 per person that you are claiming an exemption for. So if you had 6 people who are being exempted, you would end up saving tens of thousands of dollars from your adjusted gross income and lowering your property tax bill. Those exemptions were done away with in exchange for increasing the standard deduction. So that was the trade-off that was made in that 2017 piece of legislation. So now we just have deductions. We don't have exemptions. We have deductions. And it's important to note that deductions are powerful circuit breakers in that they will lower a taxpayer's tax liability. But deductions are what we call above the line subtractions, meaning that deductions are subtracted from your adjusted gross income before you calculate your tax liability. So if you have an adjusted gross income of $100,000 and you have $20,000 in deductions, that lowers your income to $80,000, and then you would take that $80,000 and apply it to your tax bracket table to see how much your tax liability is on that $80,000. That's what we call it above the line with deductions, in that it's coming off your adjusted gross income. Tax credits are different in that tax credits are what we call below the line types of deductions. With a tax credit, you subtract that credit directly from your tax liability. So you go through your calculation, you get your adjusted gross income, you apply the tax table, and here is my tax liability. So my tax liability is I owe $10,000 in federal income taxes. But then I have a child tax credit of $3,500. I subtract that $3,500 directly off my $10,000 liability. That is then lower my liability to $6,500. That's a very powerful tool because credits come off of your tax liability, deductions come off of your adjusted gross income before you calculate your tax liability. So a $3,500 tax credit is much more powerful than a $3,500 deduction. If it was a $3,500 deduction, it would come off of your $100,000 of income. You would still have $96,500 of income that you're paying taxes on. It would just have a very small incremental impact upon your tax liability. However, if it's coming directly off your tax liability, it's going to have a much more pronounced type of impact. The problem that we run into with income tax code is we oftentimes refer to things as credits that are actually deductions. We like to call deductions credits. They're not truly a credit unless they're coming directly off your tax liability. So if they're calculated after you calculate how much tax you owe, then they're a true tax credit. If they're coming off your adjusted gross income before you calculate your tax liability, doesn't matter what they call them, they're a deduction. So that's the big difference between deductions and tax credits. So circuit breakers are ways in which we can reduce the liability of taxpayers to reduce their nominal rate to a smaller effective rate, the actual tax rate that they are paying. But there are problems with these circuit breakers. The more circuit breakers, the more deductions, the more credits that you have, the more confusing the tax code becomes. And the more you build these into your tax code, the more the need to have tax professionals to file people's tax forms. And you can no longer file it on a postcard or on one page of paper. And it has made for a very complex and very confusing income tax structure. There's also what we call a lack of indexation with circuit breakers. So you establish a deduction in a certain amount for a deduction, or you establish a certain amount for a tax credit. If you don't change that amount and you don't increase that amount to keep up with the cost of living and the increases in the COLA, then the value of that tax credit deduction is going to be reduced each and every year because the value of money changes with each passing year. Indexation is making small marginal increases to those deductions and those credits in order to keep up with the cost of living and keep up with inflation. There's also this thing called the AMT, the Alternative Minimum Tax. And another thing that 2017 piece of legislation did is it indexed the alternative minimum tax to make sure that the alternative minimum tax affected fewer middle-class taxpayers than it affected previously. The purpose of the alternative minimum tax is to make sure that people from upper income levels pay at least a certain amount in taxation, that there's at least a floor, regardless of the deductions and exemptions or deductions and credits they can claim. Everybody has to pay a certain amount in taxation that you cannot go below, regardless of what types of deductions and credits you have available to you. So if you're above a certain amount of income, then those deductions and those credits start to go away, and you're no longer eligible to claim those deductions and those credits. That's what's called your alternative minimum tax. The problem was the alternative minimum tax was designed to affect the top 1 or 2% of taxpayers. But because Congress had not kept up with indexing it and making changes to it each year, once we got into the 2000s, the alternative minimum tax was actually not only affecting the top 1 or 2%, it was affecting middle income, upper middle income, and middle income taxpayers that was never designed to target. And so finally in 2017, Congress re-indexed the alternative minimum tax so that people who used to be getting caught up in paying the alternative minimum tax are now exempt from the alternative minimum tax and can still claim those deductions and those credits. So there are some things that help taxpayers in the 2017 Act. There are other things that hurt the average taxpayer as well, such as the elimination of exemptions and the capping of the state and local tax deduction. Then we have what are called payroll taxes. Payroll taxes are taxes that are taken out of your pay in order to fund things like Social Security and Medicare. So 6.2% will be taken out of your pay to fund Social Security up to your first $147,000 of income. So up to $147,000 of income, 6.2% will come out to help fund the Social Security Trust Fund. And 1.45% will come out to help fund the Medicare Trust Fund. That's only up to your first $147,000 of income. Once you make more than $147,000, amounts earned above $147,000 are then not subject to those payroll taxes. So it only goes up to the first $147,000. If someone works for multiple employers, second and third employers aren't going to know what the first employer is doing. And so they're going to continue to withhold Social Security payroll taxes and Medicare payroll taxes, even if your income is above $147,000 because of those multiple jobs. And then that comes back to the taxpayer then as a credit whenever they file their taxes on April 15th. But those are known as payroll taxes, Social Security, and Medicare coming off the first $147,000 of your earned income. Let's see, is that $147,000 annual income in one calendar year over the course of your employment life? It's one calendar year, it's one tax year. So it's $147,000 of income each year. So it's just for one tax year. So let's take the income tax and let's compare it to these 5 evaluative criteria, just like we did with the property tax. So the first evaluative criteria obviously is burden distribution. The income tax is clearly an ability to pay tax because it's a graduated income tax system with those marginal tax brackets clearly based upon an individual's ability to pay. In terms of equity, it is designed to be a progressive tax because of marginal tax brackets. It at least gives the impression of progressivity, but we all know that it's not always as progressive as we would like for it to be. The reality, as we said, is the myriad of deductions and credits that are available to upper income earners means that oftentimes the effective rate for someone at an upper income level will actually be lower than the effective rate at someone at a lower income level. Warren Buffett is very famous for saying that his effective tax rate is lower than his secretary's effective tax rate, who makes a fraction of what he makes every year. And it's because of the existence of all these circuit breakers that Warren Buffett has access to. So it gives the impression of progressivity, and that's why taxpayers tend to favor the income tax over the property tax. But we all know the reality is that sometimes it's more regressive than it probably should be. Adequacy, it tends to be a very adequate type of tax. That's why the federal government is so heavily reliant upon federal income tax revenue. That's why state governments are also very reliant upon the income tax as well. In terms of collectability, as we had said before, it depends. In some aspects, it's very taxpayer passive with things like payroll deductions and withholdings, which makes it very collectible. But then come April 15th, whenever we have to fill out our taxes and make a declaration of the amount we owe and remit that tax, it becomes very taxpayer active, which makes it a little bit more difficult to collect. Economic effects, there can be these distortions that we call the distortions of work and leisure, in that the higher the tax rate goes, the less likely it is that people will work overtime, because it's less likely that they will say, well, it's worth it for me to work overtime, because by working overtime and earning this extra income, it's going to push me into a higher tax bracket, and being pushed into a higher tax bracket means that I'm not going to be able to keep much of that money. So it kind of changes their preferences from work to leisure. So it can have an impact upon the economy. Clearly, when we have high rates of unemployment, a lot of people out of work, we're going to have less income tax revenue coming in. So it is relatively closely tied to economic fluctuations, much more closely tied to economic fluctuations than what we saw in our discussion of the property tax. Then we have our third type of taxation, which are consumption-based taxes, primarily what we like to refer to as sales-based taxes. Consumption-based taxes can be divided up into two broad categories, general versus specific. So a general consumption-based tax is something like the general sales tax, where a state may have a general sales tax of 5% that applies to all commodities that are transacted within that state. It's a very general tax that applies to all commodities, or at least the vast majority of commodities. Then you can have specific consumption-based taxes like selective excise taxes. Selective excise taxes will apply differently depending upon the commodity that's being transacted. So I've listed on the screen for you some prominent examples of selective excise taxes, specific consumption-based taxes, things such as luxury-based taxes. So you have a luxury-based tax on something like a yacht. So the idea is you will charge people this higher tax rate when they purchase yachts because you are targeting upper income individuals, because it's those upper income individuals who are much more likely to purchase a yacht. The problem, though, is there are some negative externalities that are associated with a luxury-based tax. Yes, the consumer, the upper income individual, when they purchase that yacht, will be paying this luxury tax. But if the luxury tax becomes too expensive, it has a price effect. If the yacht becomes too much to pay for, then people will stop purchasing those yachts. Even upper income individuals will stop purchasing yachts. If fewer yachts are being demanded, then fewer yachts are being produced, which means that you have people at the shipyards who are then going to be out of work because there's less demand for the production of these yachts. So sometimes with the luxury tax, you're trying to target upper income individuals, and the trickle-down effect is actually a very negative impact upon people you don't want to target, people from lower income levels. So you have to be really careful whenever you use these types of luxury selective excise taxes. The second type of selective excise tax that's become very popular among governments is what's called a sumptuary tax. A sumptuary tax is a sin tax. So this is a tax on alcohol or on tobacco products. And the idea here with a sumptuary or a sin tax is they're relatively easy to sell to voters because they're sold based upon hypocrisy. So elected officials will say, we're going to institute the sin tax to generate revenue to construct a sports stadium, or however a lot of sports stadiums have been constructed with proceeds from sin taxes. So we're going to get all this revenue that we can use for our sports stadium, but at the same time, we are going to depress the consumption of this socially undesirable activity, such as consuming alcohol or smoking cigarettes. The problem with that is it's hypocritical. That if you are going to generate a lot of additional money with a sin tax, you're going to do so without depressing consumption. That if there's a price effect and it's very inelastic demand, then by increasing the price with this tax, you're going to end up depressing consumption, which means that you're probably not going to generate a whole lot of money from this sin tax. So you can't have your cake and eat it too. You're either going to generate a lot of money with the sin tax because it's a very demand inelastic type of good, or you will reduce consumption because it's very demand elastic, which means you're not going to generate a whole lot of money. So it's kind of hypocritical how these sumptuary taxes are oftentimes sold, but they're very appealing to voters because voters love to engage in burden shifting. So voters tend to prefer taxes that afford them the opportunity to shift the burden onto another taxpayer. So if I don't drink alcohol, if I don't consume tobacco products, I don't have to pay the tax because it's a benefits received type of principle. Somebody else is paying the tax, so I'm shifting the burden onto someone else. The more the potential for burden shifting, the more politically appealing that form of taxation tends to be. And then a third example of a selective excise tax is a benefit-based excise tax. So a classic example of that is a gas tax, motor fuels excise tax. The idea is that we will charge this tax on gasoline. We will then capture the revenue that we're generating from this gas tax, and we'll then earmark that money for road construction and reconstruction. Because ostensibly, when someone is purchasing gas, they're putting in their car, they're then driving the car on the roads. Driving the car on the roads means that you are going to have wear and tear on the roads. You're getting a benefit from driving on the roads, but then you pay for that benefit from this gas tax. So it's a benefit-based type of excise tax. We have gas taxes at the federal level. We have gas taxes at the state level. Again, motor fuel consumption tends to be relatively demand inelastic. And so we do tend to generate a good bit of money to put into the highway trust fund for road construction and road reconstruction. But you have to also be careful. There's a prominent example from many years ago in Washington, D.C., where the mayor decided we're going to increase gas tax in Washington, D.C., and it'll be a great way for us to generate a lot of additional revenue because demand for gas is very price inelastic. And so people are always going to have to purchase gas. What they found out is as they increased the tax on gasoline, the amount of revenue they were generating actually went down. Why do you think the amount of revenue went down in D.C. instead of going up as they increased their gas tax? What do you think the reason for that is? You think about Washington, D.C. Yeah, there's a lot of public transportation. And Washington, D.C. is well known for its metro, and it has really good public transportation. So there's an alternative for people in Washington, D.C. They don't have to drive a car. They can always take public transit. And so that accounted for some of it. But also when you think about where Washington, D.C. is located, it's located basically in Virginia and Maryland. And so if you had to purchase gas, and if the gas tax is much higher in D.C. than it is in Virginia or Maryland, you drive to Virginia or Maryland, you fill up your tank, you drive back home to D.C. They kind of forgot about their geographical proximity to these other states that had much lower gas taxes. So you got to keep in mind your geographical proximity to other jurisdictions that may have different types of tax rates. So overall, it was a failure for Washington, D.C. when they tried to leverage their gas tax to gain a lot of revenue. But those are selective excise taxes. They are applied differently to different types of commodities that are transacted. Well, let's get back to the general sales tax, because it's really the general sales tax that is very troubling from an equity perspective, because the general sales tax has this tendency to be very regressive in nature. If you are charging this tax to all commodities being transacted, including the staples of life, as we had said before, people from lower income levels have less disposable income, less income left over after purchasing the staples of life than people from higher income levels. So unless you have the right commodity-based exemptions, if you're charging this tax for everything, including the staples of life, it will be a very regressive tax. And that's going to hit those lower income individuals harder than upper income individuals. That's why most states will have a series of commodity-based exemptions for their general sales tax. So they will exempt certain types of food, depending on either the type of food or where the food is consumed. They will exempt, in some states, up to a certain value of clothing per year can be exempt from the sales tax. Prescription drugs, pharmaceuticals are usually in most states exempt from sales taxes as well, because you want to try and exempt the staples of life to try and make what is usually a regressive type of tax a little bit more progressive in nature. We tend to use the sales tax here in this country, again, at the state and the local level. So the state will have a general sales tax rate, and then there'll be a local option sales tax. Here in California, we call it the Burns-Bradley Amendment sales tax, which is a local option sales tax that's added on to the sales tax rate that's charged at the state level. So the state has a 6% sales tax rate. You may have a county that then has a 3 or 4% add-on on top of that sales tax rate to get this overall sales tax rate up to maybe 9 or 9.5 or 10%. But it's usually the domain of state and local governments. There is this thing known as a VAT, a value-added tax, that we do not use here in this country, but every session of Congress, there's a bill introduced to try and start a value-added tax here in the US. A value-added tax is most commonly seen in European Union nations, and the idea behind a value-added tax is that you will apply tax incident at every point in the production process where the value of a good increases. So whenever a good goes from the raw material to the manufacturing stage, it increases in value. And so a tax is then imposed at that manufacturing stage. As it goes from the manufacturing to the wholesale stage, it increases in value again. And so there's a tax applied to the wholesaler. As it goes from the wholesale to the retail level, it increases in value again. A tax is then applied to the retailer. And then eventually when the consumer comes in and purchases it, then it increases in value again, and a tax is applied to the consumer. But the idea is that you're spreading out the burden of taxation, not just for the consumer, but you're spreading out to the retailer, the wholesaler, and the manufacturer throughout the entire production process. And the argument behind the value-added tax is that then shields your consumers because they are then not paying 100% of the tax burden. However, we know that's really not the case because, as we said before, taxpayers love to engage in burden shifting. And there's a process known as forward burden shifting and a process known as backward burden shifting. So the tax liability can be shifted forward through the production process or can be shifted backwards through the production process. Being shifted forward through the production process, you can guarantee that manufacturer is not going to lose money based upon the taxes that they're paying. So they're going to charge a higher price to the wholesaler, who will then charge a higher price to the retailer, who will then in turn charge a higher price to the consumer. And the burden again gets shifted through the production process. In a backward burden shifting process, consumers will refuse to pay the price for a commodity, so the retailer would have to reduce the price, and then the manufacturer would have to reduce the price, and so on and so on. So it can be shifted forward or backward. But at the end of the day, typically with a value-added tax, consumers are still paying the tax. It's just hidden in the higher price for that commodity that they are purchasing. The brave new world of consumption-based taxes has really involved the internet and internet e-commerce. And there's been an outstanding question in e-commerce about how much access state government should have for taxing transactions that occur online. There's a very famous case from way back in the early 1990s, Quill versus North Dakota. And you might say, well, not early 1990s, how much e-commerce was going on in 1991 or 1992? Not a lot, obviously. And the Quill versus North Dakota case was actually a mail order catalog case, in that you had this corporation called Quill Stationery Corporation. And Quill Stationery was located in the state of Minnesota. And they were selling things through their mail order catalog to residents of the state of North Dakota. Well, the state of North Dakota wanted to tax those transactions. So they started taxing the transactions that Quill was engaging in with residents in North Dakota. Quill obviously said, you can't do that because we don't have any offices in North Dakota. You can't tax us. We're a Minnesota company. So another state cannot tax our transactions because we are not physically located in the state of North Dakota. The Supreme Court agreed with Quill. And the Supreme Court said that in order for a state to apply its sales tax to remote transactions, that corporation must have what they called a physical presence nexus. Put that in text chat. A physical presence nexus in the state. So in order for North Dakota to charge their sales tax to these transactions conducted by Quill, Quill would have had to have some physical presence in the state of North Dakota. A retail outlet, a wholesale warehouse, they would have to have some type of physical presence, which they did not have. So it establishes this judicial precedent of you can only charge taxation if there is a physical presence nexus with the corporation. Corporations that don't have that physical presence nexus are referred to as remote sellers. And transactions conducted by those remote sellers can then not be taxed if those remote sellers don't have that physical presence in the state. So what a lot of states did after the Quill case is they all got together and they formed this kind of informal interstate compact known as the Streamlined Sales Tax Project. And they put together uniform legislation that many states then adopted that would allow them to collect taxation on these remote sellers at a zero cost burden to the corporations. So basically what the state said is, if we are able to have access to taxing these transactions, we will handle all the costs of collection. We'll handle all the costs of calculating the tax, of collecting the tax, and remitting the tax to the State Department of Revenue. We'll handle all that. Corporations, you won't have to worry about paying for any of it. And so some major corporations, some major retailers kind of bought into that. And they started charging taxes for everyone, regardless of whether or not there's a physical presence within that state. More recently, though, a couple of years ago, we had this Wayfair case. And the Wayfair case essentially overturns the Quill case and that precedent. And the Wayfair case says that you can charge your sales tax even if that corporation is a remote seller, even if that corporation does not have a physical presence nexus within the state. So what the Wayfair case has done is it opened up billions of dollars in additional sales tax revenue to states that they can then apply their sales tax rate to these remote transactions online to generate a ton of additional revenue. And author by the name of Fox at University of Tennessee every year puts forth projections of how much revenue overall states are able to generate as a result of gaining access to e-commerce. And every year that goes up. And I think that the last estimate was something in the range of about $150 billion in additional sales tax revenue that will be afforded to states by taxing electronic commerce. But one thing to remember, though, is that even before the Wayfair case, even if you were purchasing something online from a corporation that didn't have a physical presence within the state, and you were not required to pay sales taxes on it, you were still subject to what's called the use tax. So every state that has a sales tax also has what it calls a use tax. A use tax is a tax on the value of the commodity that's being brought into the state to be consumed. So if you're a resident of California before the Wayfair case, and you purchase something online from a corporation that didn't have a physical presence in California, the corporation would not charge you a sales tax on that transaction. However, you are bringing that good into the state of California and essentially consuming that good here in the state of California. You're using it up in California. So because you're doing that, you have to then remit a use tax on the value of the commodity that you are consuming within the confines of the state of California. That use tax gets reported on your state income tax form, And if you do your own state income taxes, you probably have seen this line for use tax. Ask you the value of commodities that you have purchased and brought into California to use. You're supposed to report that value and then pay a use tax on the value of those commodities. Many years ago, I did a study looking at several states and their collectability of their use tax. And I found out that the collection rate in those states I looked at of the use tax was less than 0.0001%, because people just don't report the value of things that they're bringing into the state and then paying that use tax. So even though it's a line on the state income tax form, the collection rates are very low for this thing referred to as a use tax. But just be mindful that every state, there are 45 states that have sales taxes. All 45 of those states also then employ this thing called a use tax. So let's look at consumption-based taxes relative to these 5 evaluative criteria. Now, we've kind of covered this, but we'll just recap it again. In terms of burden distribution, we know that a consumption-based tax is a benefits received principle. You pay a tax based upon the benefit that you are accruing by consuming that type of commodity. So it's very much benefits received. It tends to be a very regressive tax unless you're able to incorporate the right mixture of commodity-based exemptions. It's going to hurt lower income individuals more than upper income individuals. It is a very adequate yield, and that's why state governments are very reliant upon sales taxes and local governments are reliant upon sales taxes as well. It is very collectible because, again, it's being collected by vendors as opposed to being collected by individual taxpayers. It's rolled into the price of the good, and then the state will provide some indirect costs to the vendor for remitting that tax. And so if it's say a 6% tax rate, they might have an indirect of 1% where the vendor will remit 5% and will hold on to that additional 1% to pay for their inconvenience of collecting and remitting that tax to the state government. And so it's an incentive and inducement to get very high collection rates from these vendors. In terms of economic effects, the sales tax is one of the 3 that is most closely tied to the economy. Increasing your sales tax will then have a price effect. That price effect could then very much have an effect upon demand and consumption. The second street of how the economy affects sales tax revenue, we know that in poor economic times, people have less disposable income, and so therefore they're doing less in terms of consumption, and you'll get less sales tax revenue. So it's very closely tied to the state of the economy. So what does that mean then for local government, cities here in the state of California? Where are they getting most of their revenue from? You'll see on the screen, we've got this pie chart that kind of shows you the breakdown of revenues here in the average city in California. You'll see in terms of property taxes, we're looking at about 14% of revenue coming from property taxes for the typical California city. Now, you may look at the budget for your city or the CAFR for your city, and you may say, my city is getting 50 or 60% from the property tax. There's a lot of variability in terms of different cities. But this is your typical average California city, 14% from the property tax, 7% from the local option sales tax. You see 2% from business licenses, 3% from utility user taxes, 2% from what are called transient occupancy taxes. Those are hotel taxes. And again, that's great variability in that if you're in a city like Anaheim that has Disneyland right there, you're going to get a lot more of your revenue from hotel taxes than a city that doesn't have that type of a tourist attraction. Franchise fees, 2%. State and federal taxes, less than 1%. Then you'll see on the left side, this is where a lot of the money is coming from today that it was not coming from back before Proposition 13. Utility fees. So fees that are coming from water, sewer, refuse, electric, and gas services, those utility-based fees for the typical city makes up 29% of the revenue. So over double what they're getting from the property tax. Other fees making up 12%, developmental fees making up 2%, licenses and permits less than 1%, fines and forfeitures 1%. But if you add all that up, utility fees, other fees, developmental fees, just add those up, you're looking at 43% of revenue coming from those non-tax sources of revenue, which again is a very big shift from what we saw prior to 1978 and prior to the passage of Proposition 13. They can see things like intergovernmental grants, federal grants 5%, state grants 4%. So they're getting on average about 9% from intergovernmental grants. And so it's interesting to take a look at your city and see what percentage they're getting. Some cities are a higher percentage, some cities are a lower percentage. So we'll admit there's a lot of variability. But this just really underscores the major shift in the portfolio diversity, revenue portfolio diversity of local governments before and after the passage of Proposition 13. So now we're very heavily reliant upon non-tax sources of revenue, which then begs the question about, well, where does this revenue come from these non-tax sources? And so very quickly, as we finish up tonight, we'll talk about some non-tax sources of revenue because they have become so prominent in the portfolios of most local governments in California. The two primary sources of revenue from a non-tax source of revenue is charges and fees, user charges and user fees. Now, the caveat here is that most local governments will use the terms user charge and user fee interchangeably with each other. So they'll oftentimes say charges/fees, and they'll use those terms interchangeably. Mike Sell tells us that there is a distinction between what is considered to be a charge versus what is considered to be a fee. A charge, according to Mike Sell, is revenue that is derived from the consumption of some type of a service. So there's some service being produced, people consume that service, and they pay a charge for the benefit of consuming that service. That's considered to be a user charge. A user fee, according to Mike Sell, there is no particular service that's being consumed to generate that fee. So charges are tied to a particular service, fees are not. So examples of fees are fees that you will pay in order to get a license. So we have to get a license to drive a car. We have to, for the benefit of driving a car on the road. We have to, if we want to go hunting, you have to get a hunting license. We want to fish, we have to get a fishing license. If we want to open up a franchise, we have to get a franchise license. Those fees are charged for obtaining those licenses so that not only can government generate revenue, but government can also control how that activity is being engaged in. So if you have to get a franchise license, and then if you are doing something to violate health code, you can have that franchise license revoked. If you have a driver's license, you can get that driver's license revoked if you're doing some unseemly things on the road. So charging fees for these licenses, requiring these licenses, allows government to control how those activities are being engaged in. User fees and user charges will never completely supplant tax revenue because you have to have some necessary conditions in place in order to be able to utilize a user charge. To utilize a user charge, you need to have some private sector aspects to the goods and services. You need to have some type of benefit separation. You need to be able to separate the benefit that this individual is getting as opposed to this individual. And you then need to be able to charge that individual for the benefit that they are getting. So if someone is not consuming this type of service, they're not deriving any benefit from it, they will not pay any charge. But someone who is consuming the service will then pay a charge commensurate with the amount of the benefit that they are getting. So you need to have that benefit separation and you need to have chargeability. Chargeability means that exclusion is feasible. You're able to exclude people who are not paying the charge from getting those benefits. So it needs to have, well, basically saying it needs to have some type of a private sector element to it to allow for that excludability so that you can charge people for the benefits that they are consuming. So clearly, if you've got a social service program that is meant to help people who do not have the wherewithal to pay a charge for the benefits they're getting, you're not going to be able to charge them because it defeats the purpose of that social welfare program. So essentially, redistributive programs don't tend to work very well with user charges and user fees. Redistributive programs tend to be funded by traditional tax-based sources of revenue as opposed to user fees and user charges. We know that the vast majority of policies and programs that we pursue in the public sector tend to be redistributive in nature. We are redistributing wealth from one segment of society to another. So those redistributive programs and policies tend to need to be paid for through tax-based sources of revenue as opposed to user fees and user charges. The more spillover effects, the more externalities that you have with a policy or a program will also limit your ability to utilize user charges. Because whenever you have a lot of spillovers, you have a lot of free riders, as we discussed in the previous class. Those free riders are getting benefits from this good or service, but they are not being charged for it. So therefore, you're not able to charge them for the benefit that they are getting. You're not going to be able to use the user fee or user charge for programs that have a lot of those spillovers and externalities that create the free riders. But some programs that do tend to work really well with user charges, things like household supports, trash collection is the quintessential example of a program that works really well with a user charge, because you have benefit separation and you have chargeability and you have excludability. So it works very well with these types of household supports. Industrial development supports as well, where you can actually identify the amount of infrastructure that's being used by one business versus another business. That really does then lend itself to the utilization of a user charge. So that's why user charges will never replace tax-based source of revenue, because most of our programs are redistributive and they don't work well for redistributive programs and policies. Then another source of non-tax revenue is what we call monopoly-based revenue sources. So this can be things such as the operation of utilities. You saw on the previous screen when we showed the pie chart, 29% of the amount of revenue is coming from utilities like electric and gas and water and sewer. Those are considered traditionally being monopoly-based revenue sources. Now, they're a little less monopoly-based with deregulation in recent years, but for many years, we had cities that considered themselves to either be no tax or low tax cities, in that they could avoid charging tax rates because they generate so much money out of operating utilities. And that's where 99% of their revenue came from a government-owned and operated utility. The thing to remember, though, about utilities is that even if you have a government-owned and operated utility, that is an enterprise. And if you harken back to our discussion of accounting and fund-based accounting, you'll remember that revenue that comes in from the operation of an enterprise goes into this special type of proprietary fund known as an enterprise fund. Government can borrow money from the enterprise fund, but must pay that money back, because the money that comes in for that type of enterprise is reserved for the maintenance, operation, development of the enterprise that's generating that revenue. So we don't have the adequacy of these monopoly-based revenue sources anymore. That's why we have the vast majority of cities that do have to rely upon tax-based sources of revenue. Lotteries are another example of a monopoly-based revenue system at the state level. And we know we have a lot of lottery systems, individual lottery systems. We also have multi-state lottery systems. We won't go through the development, the history of lottery systems, but they do generate a good bit of revenue. But the downside of a monopoly-based lottery system is that the administrative costs tend to be very high that are associated with operating those lotteries. And if you saw the chart in the Mikesell book, Mikesell has a chart where he breaks down each state's lottery system based upon how efficient those lottery systems are. And he looks at administrative costs as a percentage of total revenue. California has a pretty efficient lottery system in that we have a relatively low administrative cost compared to revenue being generated. Well, you'll see some of those states in that table, their administrative cost is more than 100% of the amount of revenue they're generating, which means that they're actually losing money. And so not all lottery systems are a great source of monopoly-based revenue. Lottery systems, though, were sold by politicians as we will generate money that we can then give to education, that will use the lottery proceeds to prop up education, elementary, secondary, as well as higher education. Here in California, we do have lottery funds that go to school districts. We also have lottery funds that go to community colleges as well as to Cal States. And every year at Cal State Long Beach, we get a certain amount of lottery funds. Those lottery funds need to be used for instructionally related types of activities. So they need to be something that benefits instruction within the classroom. So there is some money coming in from lotteries, but the amount of money that you get from lottery in terms of overall education spending tends to be just a fraction of the amount that's spent per pupil, especially at the K through 12 level in education. The other downside of lotteries is not only do they have high overhead and very elastic revenue, they also tend to be relatively regressive in that the people who spend a lot of their income playing lotteries tend to come from lower income strata. And so it tends to be a very regressive type of impact. You also have externalities that are presented to us by lotteries as well. People who become addicted to gambling and make choices that distort their preferences towards spending money on lotteries. Certainly, there are those negative externalities that also accrue from having lottery-based systems. But that's just another example of a monopoly-based type of revenue source that is not within the realm of taxation. But again, despite that, we know that governments will still always generate some revenue from taxation, but the movement has been away from tax-based revenue sources and a movement more toward user fees, user charges, and other types of non-tax revenue sources, especially for local governments here in the state of California. So that's our presentation of revenue, especially revenue that comes from both tax as well as non-tax sources. Again, you saw the scenario on the final assessment that you're going to be answering that deals with revenue. Again, if you just be mindful of how these revenue sources relate to the 5 evaluative criteria. And if you relate them back to those 5 evaluative criteria of burden distribution, equity, adequacy, collectability, and economic efficiency or economic effect, then you'll be able to do a good job on that question on the final assessment. So, any questions on the different types of revenue that we have discussed so far tonight? Anything at all? What we will then do next week is we will finish up all of our substantive information. We will move into a discussion of another source of revenue, intergovernmental revenue, and we'll talk about the different types of grants, different types of mandates, and what these intergovernmental components mean for fiscal solvency at the state and local level of government. And then we'll have a few words to say about the future of public budgeting and finance, and then that will wrap up all of our substantive information next week. And then 2 weeks from tonight, you'll be working on your final assessment, and we won't do a formal session in 2 weeks, but I will be available during this period of time to answer any questions or provide any clarifications that you need on that final assessment. Again, between now and next week, if you have any questions at all about the post-instructional part 1 or part 2, feel free to send me an email because that post-instructional is due next week along with Beach Board essay number 4. Okay. I will get this recording up onto our Beach Board site no later than tomorrow morning if you want to go back and review the recording. Otherwise, I wish everyone a really good week, and I will talk to you again then next Tuesday. So take care, everyone.
Thank you.
Thank you.
Thank you. Get well.
Thank you.